Today, Inc. Research CEO Ted Dixon wonders why the Bank of Canada is still in crisis mode. Bob Hoye from Institutional Advisors tells us about investors who missed out on some great opportunities so far this year. We talk to Ted Dixon right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600. Welcome to This Week in Money, the source for market opinions. Sitting in for Phil Mackesy, here is Jim Goddard.
My guest is Ted Dixon, CEO of Inc. Research, Inc. spelled I-N-K, for insider news and knowledge. Welcome to the show, Ted.
It's great to be back, Jim. Thanks for having me.
We're doing a 6-month review of how Canada's economy is done and internationally as well. Some of the things that were missed for investors, you're saying one of the missing links might be the Bank of Canada.
Well, what's interesting, we've heard a lot about how investors have been unable to call the bond market right with rates in the U.S. first going down when everyone expected them to go up. Well, what has happened in Canada is the Bank of Canada at the beginning of the year was fretting about low inflation and thought, well, eventually it will hit back to the target. Well, lo and behold, on Stephen Foley's 12-month anniversary on the job, the Canadian inflation rate hits the Bank of Canada target at 2%, and the bank had to say, oh, well, this has happened a lot quicker than we expected. So it's not just investors who are having a hard time figuring out the economy, but I would also suggest that central bankers are also not infallible here, and perhaps investors may have been putting a little too much faith in their ability to get things right.
Some sectors are expressing horror about continued low mortgage rates. Are you concerned?
Well, I think in the first year, the Bank of Canada governors had a pretty good experience with the Canadian housing market. So far, new home prices are up modestly, just over 1%. So that would argue for a soft landing. But that's in the rearview mirror, and we don't know, obviously, what's going to happen in the future. And, you know, the big elephant in the room is still what happens in the U.S. economy. And how that unfolds, and it could unfold into different directions, you know, will have an impact on Canada, and how it impacts the housing market is uncertain. And so we have seen a pickup in insider selling in the Canadian financials. Now, what we sent around a piece last week to our subscribers saying what we're looking at, and what we want to keep an eye on in particular are insider selling levels at the Royal Bank and the CIBC Bank, because these two firms are focused in Canada, perhaps, you know, a little bit more than some of their peers. And also, you know, the Royal Bank is very much focused on the domestic Canadian banking, domestic and commercial banking sector. And the CIBC is pretty much focused on the capital markets in Canada. So we're keeping a very close eye. Right now, everything, you know, to us looks fairly stable. You know, it's not screaming that there's massive opportunity in the Canadian financials right now in the banks. Some of them have had a good run, but we are keeping a close eye. And you know, I certainly would encourage investors in the Canadian market to keep an eye on the banking insiders, and particularly ones that are in banks that are focused heavily in Canada. And you know, and so the two that pop to mind to us are the Royal and the CIBC. So keep an eye on those. And by the way, your listeners can keep an eye on those for free by going to the CanadianInsider.com website, and we update that every night with insider activity. Then there's no login required. You can just go, and also we've introduced some real free time quotes from Kayaks Canada. So there's another good reason to go to Canadian Insider. But certainly, you know, if you're concerned about the Canadian economy, let's keep an eye on a couple of the bank stocks in particular, and see how the insiders are behaving, and whether they're taking money off the table in big numbers, or whether they're just playing it cool. And right now, they're playing it cool, so that's a positive sign.
Just saw a rating agency give Scotiabank a negative risk assessment right now. So you're right. things are happening in the Canadian banking sector. They told us, well, I suspected something was going to happen about 6 months ago when the Bank of Montreal announced record profits, and right after that, the layoff of hundreds of people.
Right. So, and again, we're not banking specialists, but each bank kind of has its own strategy, and Bank of Nova Scotia a bit more internationally focused than, say, the Royal Bank. The important aspect in all of this, though, it has to be what happens as the Federal Reserve winds down its quantitative easing. And we have a situation where both Canada and the U.S. have inflation rates that are more or less on target with what central banks need. Yet there, at this point, is a denial that these rates, these inflation rates are happening. And the Bank of Canada continues to say, well, this isn't really a problem. But, that's fine for the people of the Bank of Canada who have index pensions. If they make a mistake, they're not going to feel the pain like the typical Canadian does not have an index pension. So there is some cause to be concerned. And the other, just looking down the road, I think Canadians, have probably taken their financial stability for granted, which is, not for granted, but they've assumed it's always been there. But, going forward, we have this 2% inflation target. Yet we're not living in a world where those wage gains are as easy to come by as used to be. At least that's my assessment. I know in the U.S., people were, during booms were able to get wage gains of 5% a year. Well, now it's down to more like 2 or 3% a year. So if you have an inflation target of 2%, it's a lot different if you can expect 5% a year wage gains as a worker compared to a world where we now seem to be in, where wage gains are a lot harder to come by for most users. So most Canadians and people in the economy, I would argue. So, as we head into the next federal election, I would encourage Canadians to start thinking about that. And every time they go to the supermarket, ask themselves, is this a smart policy where the Bank of Canada is told they have to decrease my purchasing power by 2% every year when I'm barely getting a raise, of 2% a year? Why are my elected officials telling the Bank of Canada to, in fact, make me poorer every year? And this is going to be, I think, an issue that Canadians are going to have to watch, or they're just going to watch their standard of living go slow, disappear slowly, slowly over the next few years. So, anyway, you asked about the last 6 months. There's something maybe for the next 6 months to 6 years, but it certainly, inflation has been something that has, I think, surprised the Bank of Canada, and we'll see if it keeps surprising them because they're continuing to downplay its importance.
Why won't the government tell us what the true rate of inflation is? Because they leave out housing and energy. What costs more?
Well, this is the other issue. First of all, the CPI is measured on a basket of goods that represents across Canada a compilation of purchases. But for every individual, their weighting is different. And you're right. I mean, so much. Anytime inflation goes up, you'll find a central banker say, "Well, the core rate, which doesn't include energy or food, isn't going up." Well, I say big deal to that. And this core inflation rate really has no place in my view, in policy making. It's irrelevant. It's irrelevant to taxpayers who backstop these institutions. What matters is what Canadians have to pay. And that, unfortunately, includes food and energy. So it's of no comfort to hear anything about the core inflation, and I would just tune any discussion of that out because it tends to be used to as more of an excuse than anything else in terms of not making a decision to get real prices back under control. I mean, that's our view. And, I'm bringing this back to the investment context. I think it's important for investors to keep an eye on financial insiders, what they're doing, and to see, making sure that the smart money in the industry is staying there, that it's not leaving. It's something to watch. It's something because the Bank of Canada has kind of, in my view, got behind the curve on this. We'll see over the next few months whether things play out the way that they suggest. So keep an eye on what the inflation rate in Canada is doing and how insiders are reacting to that.
With a federal election expected in Canada next year, are we going to see the old usual trick of bribing taxpayers with their own money?
Well, you'll have to ask, I think, the new finance minister that, and, one would hope that policy is provided with a view that there's going to be an election fought on it. So hopefully there will be some less of that, but we will see.
I haven't heard much debate about the Canadian economy, really. Justin Trudeau trying to defend his position on freedom of choice, and other people talking about it. But again, you talk to the average person, they talk about their inability to buy what they used to buy just a few years ago.
Well, there's a reason why we don't hear much about the Canadian economy, because it's not too bad, and this is the other issue. We have the Bank of Canada basically setting interest rates at a crisis level. Their overnight rate is the real rate is minus 1%. But you know what? Believe it or not, out of the last 7 years, the Canadian economy has outperformed the American economy in 6 of them. So no, the economy is not doing great, but it's relatively speaking, it's not doing bad, especially compared to the U.S. Our inflation rate is on target. So, but there are a few issues out there, such as high levels of household debt. So the economy, there may be a little bit of complacency in the Canadian economy, but on general, we haven't been doing too bad. We've benefited from a stable financial system. So the question would be, why do we still have this crisis management going on at the Bank of Canada? I think, and don't get me wrong, I'm not saying for 1 second, we should be jacking up interest rates, but just the whole kind of mindset that we're in this crisis is the fact of the matter is we're not in a crisis.
We'll have more with Ted Dixon next on This Week in Money.
Always consult your investment professional before making any investment decision. More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. We're speaking with Ted Dixon, CEO of Inc. Research Corporation, Inc., INK, Insider News and Knowledge. On the 17th, they're expected to make their announcement on the Gateway pipeline through northern BC, which would come out in Kitimat on the west coast. A lot of opposition locally to it, but I'm told if you want Canada's economy to grow, we have to get Alberta's energy out somehow.
Well, it'll be a very important decision. If I were to make a bet, and this is always probably not a great thing to do, I got to think that the government's leaning towards doing it for a number of reasons. But there will be certainly a lot. There's a lot of opposition to it, and that will weigh in as well. I think it's a tough one to call, but on it, on balance, it's probably going to be a hard decision for the federal government to say no to it. When you look at where their base is, it's in Western Canada resource provinces, particularly in Alberta, Saskatchewan, and looking forward to the election. You asked about the election going forward. The last time I checked, the two opposition parties were opposed to Northern Gateway. It would provide the Conservatives with what we would call a wedge issue in politics. But we'll have to see. There will be I'm sure they will weigh the pros and cons, and it could go either way. But it wouldn't surprise me if they do come out in favor of it. I think that would be certainly, if they do allow for it, it would be very good news for Canadian oil patch. But the Canadian oil patch has been doing quite well, and it's been a combination of technology and innovation. We hear a lot about primarily through the American media about social media innovation and how all these great technological advances come out of Silicon Valley, and this is all very true. But there's been massive innovation in the Canadian oil patch over the last 5-10 years, and we continue to see it. So while, in general, we see some edginess of insiders in terms of taking money out of the market, based off of the big run that the stocks have had, at the stock level, there's lots of stories going on where you've got companies that are figuring out new ways to exploit different basins and different situations under the ground that generate surprisingly higher levels of cash flow than people thought. So there's still plenty of opportunity in the Canadian oil patch. A lot depends on the price of oil. As we get to this 105 area, there's only so much people around the world can pay for oil. There's been some supply disruptions, or there's been talk of supply disruptions of what's going on in Iraq. So we'll have to see how that plays out. But the fact of the matter is there's been tremendous innovation in the oil patch in Canada. Both getting the oil and gas out of the ground, but also shipping it to market. And the railways have invested quite a bit into moving oil by rail, and you've got not just railways but pipeline companies that are building terminals. So there's been this massive entrepreneurism to respond to the dynamics in the industry. So while the Northern Gateway is important, it's not the make it or break it. I would say, I know we're not energy analysts either. We look at all the stocks across the market, but if the government were not to approve it, I don't see that being sort of the big catalyst for a sell-off. I mean, it wouldn't be great news, but so far the ingenuity of entrepreneurs in the energy sector in Canada has been quite remarkable.
Is there any concern that we've overestimated the amount of natural gas we can get from fracking? I heard a report that California has overestimated their fracking capacity by over 90%. Or is that just unique to California?
Well, California is, an interesting public policy area that, they've got some of the highest tax rates in the United States, and, they kind of do their own thing. I just look back to 2 years ago when, in 2012, where oil or gas prices were tanking, and people were saying, well, they could go zero bid. There's so much natural gas. The whole industry is finished. I mean, there was like super gloom, just a couple, 2 or 3 years ago. Yet look how it's changed so quickly. So, I think it's still a cyclical industry. You're going to go through these periods of exuberance and downbeat periods of, the more depressed emotions in the industry. But in general, what we've seen in the past few years has been some pretty remarkable innovation in dealing with opportunities. Now, let's bring this back to our discussion earlier about inflation. What would happen if inflation were to move higher than expected, particularly in the United States? Interest rates would rise, and that would choke off demand for a lot of these products, and also the willingness to store them. So, how the inflation rate unfolds here over the next few months is very critical. If it stays benign, if it stays into the sort of 1.5%, 2.5% area, then maybe some of the current, I would say, sort of complacency we have in the market, will be justified. But if it starts to slip away, and there's very real dangers in the U.S., it could slip away if things get going. If the genie gets out of the bottle, there's lots of fuel there for a fire to start with what the Fed's been doing for the past few years. We'll have to see. But higher inflation, while it would maybe provide an initial boost to commodity prices, once central bankers try and corral it, it would not be a very good scenario for investors in that industry.
Which sectors are most vulnerable right now?
Well, from an insider perspective, insiders are a sentiment gauge when we look at sectors, so it's important for investors to put that in context with what other tools they would look at, including fundamentals. But right now, the two consumer sectors in Canada seem a bit vulnerable, particularly with a central bank that seems quite happy to try and talk the currency down and drive down global purchasing power of Canadians. Can make it harder for some, grocers and food distributors to compete, and it could also hurt some consumer cyclical companies if Canadians have less money to spend because their dollars don't go as far. So the risks have gone up. If the Bank of Canada at some point cools it on its sort of soft dollar talk, then maybe we'll see a bit more stabilization in terms of sentiment there. So I would keep an eye on that. I would keep an eye on the financials and be very careful in terms of how events unfold around Canadian financial stocks that have a lot of exposure to the Canadian domestic market. And then as I mentioned, right now everything seems to be pretty stable, and that's good. Just there are some potential vulnerabilities there, and we would definitely keep a close eye on what Canadian bank stock insiders are doing over the next few months.
Concerns over Europe's banking situation with negative interest rates there as well?
Well, it's given the market a bit of a lift, and I think that how it plays out in the currency markets will be quite important. The euro, after initially selling off, has kind of strengthened, so that would be, in general, a good development for, I would say, gold. In that, if the U.S. dollar were to start really rallying in the currency markets against the euro and the yen, for example, gold could, face some headwinds, depending on what the circumstances are. But in general, a stronger U.S. dollar is not so good for gold. So it's interesting that gold seems to have found a base here around 1250. It's kind of the weak period for gold. So we'll see what happens over the next few weeks if the euro continues to remain relatively strong. And we'll have to see how the Fed reacts to its inflation rate at 2%. If it keeps the same old story as they meet over the summer, that they're going to keep rates lower for longer and inflation keeps going up, well, that would probably be supportive for gold and supportive of the euro. So, but we'll have to see. They may surprise. The Fed may come out and say, oh, no, we don't like this inflation moving up. We may have to raise rates earlier, and then that whole equation for gold becomes a different scenario.
Ted, is there a website people can go to if they'd like to find out more about Inc. research?
Sure. Our subscription service is based out of inkresearch.com. It's INKRESEARCH.com. Or you can go to our free site at CanadianInsider.com, where we now have free real-time quotes from Kayax Canada, and you can check out what not only the bank insiders are doing, but insiders across all Canadian companies without logging in, just to put in the stock ticker and off you go.
After the break, Bob Hoye on This Week in Money.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
This Week in Money is archived online at TalkDigitalNetwork.com.
My guest is Bob Hoye, market historian and chief investment strategist for Institutional Advisors. Welcome to This Week in Money, Bob.
Jim, good to be with you in This Week in Money.
Taking a look back over the last half a year, it's time to do our 6-month review. What is the big outstanding story you think on the investment side?
Well, I guess the big story is that the financial party has continued, and it is registering some technical and sentiment features that you normally see only at cyclical peaks in the credit markets and in the equity markets. But within that, there's been some interesting developments over the 6 months. you recall back in November, we were looking for the beat-up sector, which then was golds and silvers, base metal prices, and agricultural prices. And so we said that these things looked like they would bottom around December. They more or less did, and that we got very good rallies out of it because the commodity guys were quite disappointed over the previous few years when you had good highs for commodities in 2008, a sell-off, and then another recovery up to 2011, and we had some indicators then that looked like it was a cyclical peak for most commodities, which it was, as well as for gold and silver. So, but what you had here is the opposite opportunity came in, where these things were gloomy and dull and oversold and overlooked. So as a matter of fact, the gold, precious metals, and the base metal sectors, whether you're looking at the commodities themselves or the stocks, were not positioned by some of the leading hedge fund guys, and you had this great rally. Who knows whether they came in late or not. But on that, in March, we noted that the returns had been pretty good. I mean, I remember one junior gold stock went from $1.02 to $1.80. I mean, what more do you want? And the advice was to take some money off the table, and these things have corrected since. Now, here's the other one that some of the hedge fund managers missed, and that was one of the best returns on the year have been in long-dated bonds, the high-grade, the U.S. Treasuries or Government of Canada long bonds, and they have shown an outstanding return since around Christmas was when their bottom was, and again, they were oversold and overlooked, and people were avoiding them. But you would think, oh, gee whiz, we're looking for a rally in commodities, and that's usually not friendly to bonds. And we're also looking for a rally in bonds, which worked out. So what it was is that sometimes in these markets, Jim, you have to analyze each sector on its own and just look at it. And as I said, they were oversold and they rallied together. So then in January, we had a target on the bond future in the U.S. of 136 to 138. Got up to 138 here a few days ago, and actually it was a week or so ago. And what you have now is that, again, you got pretty excited. You had some momentum in there. You certainly had high sentiment. So we would step aside from longer bonds. There's a risk now in price in the high-grade bonds. So on this sector, one should get a little defensive, shorten maturities down to maybe 3 or 4 years, and you can pick up a little more yield from maybe buying some investment-grade corporates. Then the other, of course, side of investing for income is always the problem with risk on quality, where is that interest payment always going to be made, and that thing. So what has been happening is that of recent, the institutions have been pounding into junk bonds, for example, because they're looking at effectively zero interest rate cost in buying them. And bond trading desks do employ leverage, and so you're getting tremendous carry spread out of the thing there. Whereas a few weeks ago, the small ordinary investor like you and I stopped buying junk bonds and their equivalent. So, which makes sense to me. It's been a terrific rally for the last year and a half in lower grade bonds.
Bob, maybe explain to people what a junk bond is and why they're called that.
Well, at first I heard about junk. I thought maybe it was special financing for Chinese shipping. But anyways, this is the lower grade stuff, like down to your best bonds are rated AAA. That's prime corporate stuff. And then it goes down according to the risk in the company and the instrument that's being reviewed, and right on down to triple C. And so anything lower than investment grade is a triple B or BAA. And so those are ones that various fund managers can own. But then there are bonds that they're not allowed to own, and lower than investment grade can be called junk, or you might want to call it triple C or whatever. So that's what you have. Now, also within this, they have been inventing all kinds of credit instruments, particularly with the bubble that blew out in 2007, where you take a bunch of corporate loans, actually back in '06, and then they were taking then subprime mortgages, packaging them in what they called bundling, put them together such that they then became a security, were underwritten, and the credit rating agencies like S&P or Moody's then would give these things an investment grade rating, and all they were was junk. Well, that all fell apart in the 2008 crash. There was a great deal of remorse and loss of money on that one. So then now...
Remorse, but nobody lost their job. Who did it?
I think some people would have, some trading desks would have been embarrassed on that one. So now here we are out 5 years from when the crash ended. And I saw a quip the other day that was rather good about these aggressive central bankers, is that does reckless central banking cause amnesia? Because people have totally forgotten about the risk that was discovered in 2008. So here they are. Now they're taking corporate loans and bundling together, and these would be a bunch of junk-graded corporate loans, and bundling them together into a security that they then issue publicly and put on a top rating on them. It's insane again. This is insane as it was in 2006 and 2007. So that's the quip about this reckless central banking caused amnesia. People have forgotten about risk. So, but it's not so much like your professional trading desks. It's not so much they've forgotten about risk. It's that they're pushing it to the limit, and the carry trade from zero cost to borrowing money, getting leveraged up, and you get all the income on the one side, and you get the price advance on the other side. It's been a wonderful world, and very much overdone. We've looked at momentum, and there's a thing called relative strength index, RSI, and on the junk bond price, it's up there above 70 on the weekly RS, and has been mostly above 70 since the first of the year. And you look back a few years ago, the last time you ran 5 or 6 months at this high RSI, you ended up with a terrific correction in it. And for example, last year in May, the junk bond yield got down to 5%, and there was a very, very quick and hard setback in bond prices, and that drove the yield to 6%. And that's pretty ugly. So at any rate, as that happened, we called it a mini panic. It became very oversold, in which case the price would recover. And then now you're out here. Now, also, Jim, there's a seasonal pattern in the credit markets where if you have a strong bond rally and lower grade stuff going into April, May, this is now carried through May, and it gets you into the season where you can have a sharp reversal. And it's not just North American bonds that have been in the party. You've had Eurobonds, which were a disaster in 2012. The yield on Spanish 10-year note got up to 7.5%, and now it's down less than 3%, way less. And so it, as buying risk bonds, which we consider most European bonds to be, has been a party, just buying compulsion. We have to be there kind of attitude. And it's been so determined that on one of our proprietary models, it's been registering what we call a downside capitulation. And that's been, well, four out of the last 5 weeks it's registered that. Then a couple of weeks ago, the Italian 10-year note got into that condition, buying panic going on, and it's driven its yield down to a downside capitulation. So what we would consider on this is that the best of the action is in. Prices have been, these euro bonds have been bid up to where the yield is very, very low. The risk-reward ratio is utterly hopeless. And in the last couple of days here, the last 2 trading days, the interest rates for these European bonds seem to be trying to turn up just a little. It's not much. There's nothing you can hang your hat on here. But if you were looking at the incredible excesses in the market, and the seasonality where when you get excesses at this time of the year, it can reverse. I think it's the fundamentals because, in the stock market, there's the old saying of sell in May and go away. And that also applies in the gold market. And I think it all hinges on the seasonal change in the credit markets at about this time of year.
I'm Jim Goddard. We'll have more with Bob Hoye next on This Week in Money.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. We're speaking with Bob Hoye, market historian. He's the chief investment strategist for Institutional Advisors. Bob, taking a look at the future now, Warren Buffett is throwing a lot of money into energy right now. Is energy the way or the place to put your money now?
I don't think so. Again, the crude oil was part of the rally on the beat-up stuff out of December. And we had a target of 105 on the crude contract, and it got there. We also said that probable was maybe 112, which was the last high on it. But it got there, and it's not been able to get beyond 105 cents. The other thing is that the U.S. dollar seems to have found a low, it could be an important low, a few weeks ago, and is recovering. And this has something to do with what's going on in the credit markets as they begin to falter. The U.S. dollar can firm up. Now, the other one is that you've had in the U.S. the economic expansion has been on since June of 2009, and that's 5 years. And it hasn't been a strong recovery. And even the establishment admits that, well, this really gives you the overall conditions in the credit markets, because the 2008 crash, they said it was the worst collapse since 1929, 1930. And then now with the recovery at 5 years, it's been somewhat weak. I mean, unusually weak in some numbers like employment and things like that. And the establishment has been saying it's been the weakest recovery since the 1930s. We are in a post-bubble contraction. So the way we look at...
And it seems to me that the depression of the 30s was ended when we went into World War II.
Yeah.
So are we looking forward to World War III here?
I don't think so. No, actually, when you look at some of the numbers, interest rates and whatnot, the war was an unbelievable dislocation in political and civil history, but it didn't change the financial markets. And really, the big recovery, the depression in many ways of looking at it, didn't end until 1946, and then a long recovery began. So what we're looking at here is that there's a couple of numbers have been looking good, like new car sales and pickup trucks and things have been very strong. But the overall economy has not been strong, but the view we have is that you don't have to have a business boom to end the business cycle, because this one is very dependent on what's been going on in the credit markets, and the credit markets are booming. Unbelievable. And if the credit markets falter, so does everything else. So to get back to the crude oil, there's supply is increasing with all of the oil and shale, oil sands, shale crude and the fracturing and all that sort of stuff has been a remarkable technological revolution, and there's huge supplies of it. So there's always the Middle East risk, of which there's always problems, political problems in the Middle East. But we want to look at Russia has become rather aggressive and belligerent, and its main source of hard currency is the sale of hydrocarbons. And back in the early 80s, this is how the communists were done in. The Reagan administration had a deal going with Saudis that on a recession and weaker commodity prices, the Saudis wouldn't work to try and support the price of crude oil, and it fell from $35 to $10. That cut the supply of hard currency to Russia, and the Soviets collapsed. So more recently, you've got Putin, who is trying to restore the Soviet type of government, authoritarian. And I think it would be very wonderful for the whole of the rest of the world to have energy prices decline seriously. And I think this is likely. Those two reasons. One, we may be close to the U.S. ending its business expansion and starting a recession. And two, the other one is the U.S. dollar going up. And then the third would be a cooperation amongst, say, Saudi in not trying to prevent a price decline in crude. So don't like energy prices.
Well, the U.S., according to adjusted stats, did have negative growth in the first quarter. The official definition of a recession is 3 quarters of negative growth. So are we going to see the U.S. level out, or are they going to continue to decline?
Well, the part of the downtick in GDP in the first quarter was, I think, due to the exceptional cold weather. And actually, I think my recollection on a recession, a growth recession, is 2 quarters of negative GDP. And I think things have picked up since the season changed. And as I said, car sales have been to the moon and stuff like that. So here's the deal: when you're in a world of financial manias, like in 2007, you had the stock market peak in October, and the recession started in that December. In a normal business cycle, the stock market peaks 10 to 12 months before the economy does. But when you're in a world of financial bubbles, the moment the financial side fails, it takes the economy down with it. So this also worked going the other way, because the panic was over in March of 2009, and the business recovery started in June. So there was a couple of months lag, not much. So this is what our thesis has been lately, is that so long as the stock market was up, the business and economic reports would be, let's call it, positive or favorable, not necessarily a boom. And then the other half of that one is when the stock market rolls over, the business reports and economic reports would likely roll over as well, but we have yet to see that. We think the high in the stock market is, we're very close to a cyclical peak because of the sentiment figures have been so bullish. So this could be seen in the next few weeks, and then the next part, that would be the stock market rolling over. The next part would be watching to see if business reports and economic reports start to weaken a little. So,
what about mortgage rates in Canada? We now have the credit unions offering mortgages below 3%. The big banks have been offering that. And if you go to a mortgage broker, they can get you a deal into the very low 2% range. Is that going to have a long-term impact?
Yeah, I think that if we're in as I mentioned, a highly speculative bond market, and if bond prices head down, interest rates turn up, And when market rates of interest turn up, so do administered rates of interest like mortgages. So market rates of interest go up, so will mortgage rates. And that's the way interest rates work. So, and when the main series goes up in yield, like long-term Government of Canada's or long-term U.S. Treasuries, then that and all other pricing or yields deal off of that. So we're looking for interest rates to rise at the long end and for Treasuries and also for junk bonds. And that then, once they rise for a month or so, then that would start to increase mortgage rates.
Bob, is there a website people can go to check out institutional advisors?
Yeah, but that's what it is, institutionaladvisors.com. And also, this is one of the magic items in the internet, is that one just Googles my name, Bob Hoye, B-O-B-H-O-Y-E. All our publications come up. And people are invited to take a look, take a subscription, whatever.
Thanks to our guests, Ted Dixon and Bob Hoye, and thank you for listening. I'm Jim Goddard for Phil Mackesy. We're back next week with more This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.